All right, today is Thursday, November 2nd, 2023, and it's time for the monthly portfolio update across all of my accounts. Uh, October was brutal. There's no other way to say it, especially the last couple of days of the last week. It was just completely brutal. And in fact, in October, the last day, the last trading day, was it the last trading day? No, not quite the last trading day, but it was last Friday. I made my year-to-date low across all of my accounts. It was that brutal. So it recovered a little bit earlier this week. So through October 31st, I was only down, and put that in air quotes, 1.8% for that month compared to where I was in September. So let's look at the performance and just see how bad it was, and we can get on with some of my thoughts. But year to date through October 31st, my portfolio across all the accounts is up 3.16%. The S&P actually took a pretty big bath in October. It was down 2.4%. So as of October 31st, it's up 9.77% for the year. 3.16 versus 9.77. Yeah, I'm doing way worse than the S&P 500 this year. Most of it is my fault. Actually, I can't even say that. All of it is my fault. I sat in cash for way too long. This is one of those things where you may have heard the saying that the market can be irrational longer than you can be liquid. It's kind of the same thing. I'm not trading on margins or anything, so the liquidity problem isn't affecting me. But I was so convinced that the market was overpriced and all that, and I just sat on the sidelines for the longest time, and it killed me. I mean, that's what it is. So I guess the lesson is that doesn't matter how irrational the market is. It's better to just be in there and take the returns that you're getting from the market, even when it's as crappy as what we saw towards the end of October, following on a pretty bad month in September as well. But lessons learned, I guess. And I should know better, but this is part of the problem. It's one of those where you can know way too much for your own good, and I ended up just sitting in cash and hoping that the market comes to its senses, and it didn't. So market timing never really works. I guess if I held until like last Friday and then bought in, I would have done great, because I would have gotten the 5% from just sitting in money market funds all that time. But it didn't work out that way, because honestly, even if I felt like it was overpriced and that was the right call, the problem is the timing, right? You just never know like when things will go back to its senses. You just don't. So in retrospect, I should be fully invested at all times and just take what the market gives me. And I'm going to vow to do that. We'll see what happens. So basically, I am now pretty much fully invested. I guess I was as of sometime in October. But again, bad timing, all right? I went in when things were at an all-time high pretty much, and was taking, its biggest beatings of the year, and I'm suffering for it. There's no other way to say it. The last 2 days, though, have been spectacular. I mean, through September and through October, I lost, well, I can't say I lost. I went down multiple six figures, and I'm almost fully recovered in the last 2 days alone. I say almost because I'm still below where I started a couple weeks ago, just because it was just so brutal. But I'm hoping that now that I'm fully invested, things will be good. But Murphy's Law, if I do something, the market's going to do the reverse. So we're probably in for another rude awakening. We'll see what happens. In terms of portfolio allocation, let's just take a quick look at it. I am overweight on equity, 66%, right where I should be on long-term bonds, slightly overweight on the REIT, and very underweight on the gold. What had happened was that I sold some options. on the gold call options, and it hit the strike price and it got called away from me. It's not a big loss, so I'm not really worried about it. And I did take the proceeds and put it into the equity, so it's all going to work out. But eventually, I will have to move back to my target allocation across all my accounts. And just as a reminder, this is what the target allocation looks like. So reasonably close except for the gold component, but I'll catch up on that when things are a little bit more settled. In terms of just broader economic environment, there was a Fed meeting on Tuesday, I want to say 2 days ago, and they decided to hold on any rate increases, which is a good sign. They're trying to walk this fine line about controlling the inflation, but at the same time, not trying to hurt the economy too much. They have to hurt it a little bit because that's kind of the goal, right? They're trying to bring spending down, right? So they don't want to see the labor market be too hot. They don't want to see a bunch of things that can, cause inflation to go up. It's indicative of a strong economy, which doesn't help, which is not helpful when you're trying to fight inflation, right? Because if the economy is strong, everybody has extra money to buy stuff and push prices up. But having said all that, the labor market is quite hot, although not quite as hot as it was in the past couple of months. Inflation continues to show that it's under control, and as such, the Fed are seeing good signs. So they have elected to hold in November. We have one more Fed meeting in December, and it looks like they're going to probably hold there as well. If there were to be a rate increase for the remainder of this year, it's going to be in December. But it's all contingent on what the economic data will show. How hot inflation is running, if it's going to hold in its steady band right now and lowering trajectory, how hot the labor market is. And if you read the Fed statement that went out with their decision, there wasn't a whole lot of change. They did acknowledge that the economy is on much more solid ground than it appears to be. So all in all, things actually look pretty decent. And I made a comment about, this is kind of the time that you want to be in long-term bonds because it's been a rough 2 years for long-term bonds. I'll fully admit that. If you look year to date, you're down quite a bit on long-term bonds. If you look back to 2022 to now, you're down even more. But it's that old adage, you want to buy low and sell high. And if we really are at the end of a rate hike cycle, even with one more possible rate hike in December, I think this is the time to get in long-term bonds because I cannot see how they would possibly raise it in 24, right? If they're going to raise it, it'll be in December. It won't be in 24. It's just going to be too difficult for them, which means that they're going to hold rates steady. If you're in long-term bonds, you're going to get a little premium for that, and you're sitting on 30 years, 20 plus 30 years with over 5% interest. That's not bad. And if rates were to start dropping sometime in late 24 and beyond, you're going to see huge capital gains increases in the price of your long-term bonds. Just by way of example, if we're sitting at around 5% for the interest rate and it drops just say 2% to 3%, 3 is still pretty high compared to the recent past. But if that were to happen, you would see something like a 40% increase in the price of your bonds. And that's just because the interest rate and the bond price are inverse to each other. So one goes up, the other goes down, and vice versa. And the longer your bond duration, the more this effect comes into play. So if you're holding long-term bonds, 1% decrease will give you about a 20% gain. A 2% decrease is going to give you a 40% gain. And as it approaches zero, because of this concept known as bond convexity, it accelerates even more. So as rates are getting lowered, bond prices on the long end are going to go way up. So I guess what I'm trying to say is that if we are at the end of a rate hike cycle, and I fully believe that we are, it's a great time to be in long-term bonds because you're going to lock in the high interest rate, and any decreases in the interest rate will bring you capital gains, and it could be quite significant. And even if we were to just reduce by 1 to 2 percentage point from where we are now, we're going to still be at a much higher rate environment than we have been in the very recent past. And I don't think that's really sustainable. And as strong as the economy is, which is a great thing, in all regards, at some point we're going to have a change in the business cycle. It's inevitable. And if we do have a recession of some type in 24, 25 or beyond, that is even more impetus for the Fed to lower rates faster to get the economy going again, which is, again, good for our long-term bonds. So that's my case. Anyways, I'm actually feeling good today doing the end of October update, having seen what has gone on in my accounts over the last 2 days, compared to Monday, right? Monday or Tuesday. So really happy about that. But man, it was a wild roller coaster ride. But I still think that we are in a very resilient place in the economy, and things are looking pretty good from what I can see. Anyways, thanks for checking in with me. This is the update for October 2023. I will see you in the next video. Later.